Our next guest says he does see limited likelihood of a default, telling investors to instead focus on the after effects of any potential compromise. Joining us here at Post 9, PIMCO Managing Director Jerome Schneider is with us. It's great to have you. Thanks for coming in.
Thanks very much.
You say that there have been limited signs of stress regarding default liability, and you think that might be for a good reason.
Yeah, absolutely. I think at this point in time, there's still a path, and we all know that the last second there's potential for a compromise, at least history suggests that. But the practicality is that we're seeing limited stress in the markets, in the liquidity markets, in the T-bill markets. Even at this point in time, there's only about 30 or 40 basis points of stress premium around the T-bills around the X-date. And so right now it's fairly limited, especially in a historical sense where we saw hundreds of basis points of exasperation, if you will, versus the yields. Overall, we need to think about investors from a total liquidity standpoint. And instead of focusing on the damage that can be done on a potential default, the reality is that the likelihood of impact on liquidity within the broader marketplace comes after the resolution, after the compromise in Congress comes, when we actually see the Treasury General Account rebuild and liquidity start to rebuild within that Treasury General Account, which does one thing which is very important for investors to pay attention to, which is reduces the overall amount of excess liquidity within the broader landscape. So in other words, the excess reserves that have been put into the marketplace by the reduction of the Treasury General Account in anticipation of this debt ceiling is actually going to move the other way and remove excess liquidity from the market. And that's something at PIMCO we actually think investors need to be focused on, especially as we get into the second half of this year.
So you would want to be positioned how?
Well, think about it that right now the caution is of really avoiding Treasury bills around the X-date. Have a game plan. It's not necessarily a situation where you need to think about a war going on, but have a game plan of how you need to manage liquidity. And for those investors who need prospective liquidity on a specific date, absolutely avoid certain T-bills in those segments. But in the broader marketplace, let's focus on the broader market impacts. Higher cost of liquidity means investors need to be focused on liquidity from a defensive mechanic. Focus on how portfolios can remain resilient, not because of the debt ceiling, but because of uncertainty of the economic outlook. And that's really the practical impact here, is that liquidity should be thought as an opportunistic solution to portfolio management where you can earn premiums when dislocations occur, when uncertainty occurs, whether it's economic or driven by just simply an unexpected Fed outcome that might not necessarily be in the cards right now where the market believes.
What is the credit market telling you about the level of stress in the financial system and recession probabilities? Right
now, the credit market is really focused on the regional banking sector, and with due cause, with regard to certain banks that have a prescribed funding mechanic, which is not necessarily in the conservative point of view. More importantly, though, the credit market is relatively benign, and although at PIMCO we've been very cautious with regard to corporate credit for quite some time now, we really think that we need to be more prescriptive, more insular in terms of how we think about credit risk. Credit spreads really haven't moved that much. No. And when we sit here today with the investment grade indexes around 80 or so, with a historical average closer to 125, that sort of says that there's not a lot of concern about overall credit, especially in the face of this probability of recession that we're all sort of awaiting for at this point in time. So the higher interest rates that we see right now at the front end of the market curve simply are the way that to effectively hide out. And note that there's a large amount of dispersion between T-bill yields and other opportunities to the tune of 100 basis points or so, just in that front-end landscape. And so the notion of just simply hiding out in T-bills may not necessarily be the only way to earn higher yields along the way.